I wanted to welcome everybody. Thank you very much for joining this webinar. I hope and pray that Allah subhanahu wa ta'ala is protecting all of you during these unprecedented times that we're living in, and bless you and hope you're enjoying the summer. When things were more normal, many of our sales guys, Awais Amjad Qadri in Chicago, Samir Sarmast in New Jersey, and also Haytham Al-Sayed from LA, used to come out to the communities and give these type of seminars. But since that's not happening, we thought we'd take these online and be able to do them on the webinars. So with that, as you probably know, getting started, the IRS back in March had announced that they were going to delay the tax deadline for filing. But at the same time, what they also did was they delayed also the contribution for 2019, which was last year, for all of different qualified accounts like IRAs and ESAs. That deadline was also extended till July 15th. And so last month we had a webinar on specifically about the CARES Act. But this time we decided to do it on qualified accounts. And if you still don't have, if you hadn't done it for 2019 so far, there's still time for you to do it. You can actually, if you can open up an account and be able to send the money by July 15th, it will count towards 2019. So with that, inshallah, I'll turn it over to Awais and Bismillah.
All right. Thank you, Munim. We appreciate everyone being on the call. And we are looking forward to doing these every month. And we've already had a couple and they've been fun to do. Had some good responses on them as well. I'm not going to spend too much time on each section in the interest of time. It is the middle of the day. For some of you, it's 3 p.m. already. So what I wanted to say, though, right at the top is that whatever I talk about today, please do consult with the tax professional if you need more details. It is a useful thing to do. It may cost you some money sometimes, but sometimes you can also get somebody, one of your friends, to give you some information. And of course, we always have the search engines that we can go to. We would like to present to your community if you think an educational talk like this would be useful. You'll see that basically in this presentation is just an educational presentation. I'm not trying to really sell you anything. We're trying to present to you ideas and concepts. Most of you already are purchasers of AMANA mutual funds. And so the more that people know about these guidelines and the way we run the funds, the better it is. You know, AMANA mutual funds have been around since 1986. And now we have 4 funds, 3 of which are stock funds, and 1 is based on Sukuk investments. So you have a good allocation, a good mix of different funds. So some of what I will be talking about today, which is on the next slide here, will involve numbers. So we're going to talk about, for example, some assumed rate of returns. Munim may come back at some point and talk to you about some actual returns. Just know that anything that we talk about with percentage returns are not guarantees. These are historical pieces of information that will help you to understand what has happened in the past. And the next slide talks about the S&P 500, which are the largest or most widely held 500 companies in the United States. And you know, some of the benchmarks that we have against our stock funds, one of the benchmarks is the S&P 500, which started way back in the early 1900s. Now, what we will discuss today, this is what I would tell you if we were coming out to your community or we're doing a Zoom presentation for the community. We would talk about investing according to Islamic principles, which can be used for people of any faith. Because, you know, many of the faiths actually do have some of the same principles. We just have made them strictures that we are very tight and we make sure to adhere to. And so we were not going to talk about that today, though. Investing for college, investing for retirement, and the AMANA mutual funds, although I'm not going to talk about the funds too much today. Maybe Monique will come back at the end to talk about that. But I'm going to talk about some other kinds of reasons to save as well. So why save? Buying a home, Hajj because it costs so much. And if you're not of the Muslim faith, instead of Hajj, you can just say, you know, your big trip that you want to take somewhere that's going to cost you $8,000 to $10,000. You got to save for that. That may not come out of your regular paycheck. So you have to really be deliberate about that. Children's education, I'm going to get really deep into that one, and retirement as well. And then, of course, health savings. Health savings accounts that the U.S. government introduced a few years ago are the only triple tax advantage account that I know of. So with the health savings account, you can, one, get a tax deduction. Okay, so if you have a couple or family, you can put around $7,000 per year. That's the maximum. You can put in less if you want to, but this money is going to be used for health costs, for health, regular medical visits, for surgeries, for vision, and also for dental care. So one reason to save in this is you're going to get the automatic or immediate tax benefit that year. Another reason is you receive dividends and capital gains. You might sell something within your health savings account and then buy something else. You're not going to experience any tax along the way. So that's the second tax benefit. And the third tax benefit is anytime you make a withdrawal on this, because of any of the costs that you have, you save the receipts for that, you won't pay any tax on the gain or what you put in. So it's triple tax advantage, very different than most other types of accounts that the government has set up. The next section that we're going to talk about, or the first main section, is investing for college. The numbers, are inching up every year. So this is becoming a real burden on people, and we can plan for that. I mentioned grandparents might want to save for their grandchildren's college education. There was a study done many years ago, and they asked grandparents, if the parent of the child asked you to save or asked you to contribute to the education of your grandchild, would you do it? And 71% of the people said they would. Now, what will happen though, most likely, is that the parents of the children are not going to ask their grandparents. So if you want to do something for them, this is a great way to give a gift and say, I'm giving this gift, which is larger this year, but I want you to start up an education savings account for little Johnny or little Ahmed. There's different ways to save for college. There's an education savings account, which is what we offer here, because a 529 plan exists, but there's no way to do it according to the principles that we are familiar with. So the education savings account does limit you a little bit, but for most people, they're not saving for education anyway. So this is a step up from the non-savings that most people are doing. You can put in $2,000 per child per year, and you must distribute it by age 30. The beauty of the education savings account is you can use the invoices for schooling before college as well. So if you've saved up years of invoices and now you have your child is 18, they get a scholarship and they don't need any of the money you saved for them, you can actually pull out the money tax-free using invoices from private school before they were 18, which is different than what a 529 offers. Another drawback here, unfortunately, is because they haven't updated this for at least a decade. The government hasn't updated education savings accounts, is that if your income, your adjusted gross income for your family is more than $190,000, you're going to be phased out. So what I like to tell people is, if you have an income that's close to 190,000, avoid this altogether, because then you'll have to face some consequences. If you put in money, you'll actually be taxed on that, and it takes away the advantage. So if you're below that, you can definitely consider that. Once you get to this level, then you want to think of other ways. And one of the ways, which is the next slide, talks about the minor accounts. If you go into your local bank and you want to open up an account for your child or your grandchild, that's going to be a minor account. And you can have the same thing on an investment account. So instead of having a savings account for your son or your child or your grandchild, you can have an investment account, and you can put in up to $30,000 per child per year. Now, one of the tax benefits, because that's one of the things we want to talk about, is tax benefits today. We talked about it for education savings account and health savings account. For minor accounts, if you have unearned income of less than approximately $1,000 per year, you will not pay tax on that. So if your child has a minor account earning, $300 of dividends a year, you're not going to get taxed on that money. Now, if it was under your name, you would get taxed under it. So it goes up to, I think, $1,050 or $1,100 in 2019 and 2020. This is, again, something that you want to consult with your tax person or look up yourself and confirm the information for your specific situation. This is on unearned income. This is not on earned income. Then there's some other rules that come into play, but you still get the break on what's called the kiddie tax. So it's another good way to save. Now, if you have an education savings account and you maxed out the $2,000 per year, you can open up a minor account for them as well. And when you do that, this minor account will help you to use the money for anything. You don't have to just use it for education. So if you want to use it for their wedding or to buy them their first car, or to set them up after they graduate from school, they have their own account, which basically this turns into their account when they're 18. Now they're going to have a strong footing when they go into the real world and they're working for themselves. They'll already have a nice investment account to get started. Now, on college savings, look how easy it is to save money for this. If your child is just born and you already have their social security number and you're able to open up an account for them, let's say you do that in the first month. Let's say the social security number comes really fast and you put in $83 a month. What is the significance of $83? That happens to be $1,000 a year. Now, I had mentioned that you can put in $2,000 per year into the education savings account, but this rule applies whether you're opening up an education savings account or minor account. The numbers are the same. So $83 a month. After 3 years, you would have put in $3,000, $1,000 a year. We're going to assume a 7% rate of return. This is my assumption for this particular slide. So you will have earned $194 extra on top of the $3,000. That is not too big of a deal. You're not going to be extremely excited about that. But look what happens after 18 years. After 18 years, you have put in $18,000 into this account, and now your total value will be approximately $34,000, almost doubling how much you put in. Now, if you would have put in $166 a month, you would get to closer to $70,000. You can go online and look up college planning or education savings calculator. And what that will allow you to do, if you find a good one, there's many of them out there. Most of them will work just fine. If you say my child is 5 and at 18 they're going to go to college, I have $1,000 saved for them. How much do I need to put in to get to X amount of money? It'll help you with that. Now, we mentioned HSA, we mentioned minor account, and we mentioned the education savings account. Why is it important to have more than one account? Consider this. I used to be at a financial services company before. I joined Saturna in 2008. And we used to have people come in and they would tell us they have all of their money in their checking or savings account. 75,000, 100,000, 150,000. It's all sitting in their checking or savings account combined. Now, what kind of things happen first? Does retirement happen first? Does an emergency happen first? Does college education costs happen first? What are the things that happen first, right? Does health costs come in first? So many of these things are going to happen, and by the time you get to retirement, you don't even know how much money you have left because you haven't segregated your money. Number two, if you keep it all in your checking and savings account, you're not having the benefit of these tax benefits. Health savings account, huge triple tax deduction. College education, you're not paying any tax on the dividends and on the capital gains and anything else that's going on during the time that the money is in the account. And then when you withdraw the money, as long as you have receipts to substantiate the cost, you will not pay a dime in taxes. So you would want to isolate your money into these different places. What I did with my children is I said, look, I have these accounts for you. And I want you to take a look at what they are. Because when you get to college, this is going to be your money that you can use. So get into the best college you can. And so in some ways, you can also inspire and motivate your children if you do this. If you have a separate retirement account, obviously you'll know that you'll be able to retire properly and it's not all jumbled up with the rest of your money. So if your child is 5 or 10 years old now, you may be able to put in more than if you were young and you had your first child. Now your children are a little bit older, your income has gone higher as well. You can do, on top of the education savings account, you can put money into a minor account. So wanted to make sure to tell you about that. There are some useful resources I want to mention to you. At isna.net, at islamicscholarshipfund.org. You can apply for a scholarship, different kinds of scholarships. Our company actually sponsors one each there at both of those organizations. And the last one on the list here is a accEducate.org, which is a continuous charity.org. And they allow children or students to withdraw money without any interest. And so when you pay, you'll pay this back once you get out of school. So it's an interest-free way to save for money. So if you want to take a screenshot of that, if your children are getting to that age, you can look up these different opportunities. The next slide talks about AMANA mutual funds, what we have to offer, and Saturna Capital. When we started the company back in 1986, it was started by the community. And the community decided we want to do this to be able to have more people enjoy prosperity down the road. And so there were no sales charges on any of the funds, and we still hold that today. And what that means is if you go to another financial services company, they could charge you an upfront sales charge when you're buying the fund, or they might charge you at the end when you're withdrawing the money if it hasn't been 7 years yet. We eliminated all of that very purposefully and deliberately. And so it is, all 4 of the AMANA funds are no-load funds. We offer IRA accounts here, which I'm going to talk to you about next, 401ks for your businesses that you might own, health savings accounts, education savings accounts, the minor account, also brokerage account if you'd like to have everything in one place. And if you want to do a rollover from your previous employer, you can do all of that with us. And we also will consult with you on trust services. So I want to talk to you now about investing for retirement. We're trying to get through this in a speedy way so you get a little bit of information. Maybe you're taking a screenshot of some of what I'm talking about today, and then you can look into this more. You can call us afterwards or email us, and we'll be happy to help you. So investing for retirement, there's 3 different things that you need to look at. One is that in the past, many people had pension plans where the company paid for it altogether. These days, very few people have a pension plan where the company's paying for it. You'll have firemen and policemen and policewomen and congressmen, and you might have executives at large companies. They will have a company-paid retirement account. But most people do not have that anymore because of the cost to the company. So you've taken away one leg of the retirement stool. The second one is Social Security. Now, Social Security is given out to 40 million Americans every month, 40 million Americans. And the average check is just over $1,500, with many people getting less than $1,000 a month. So that doesn't cover the cost of your life during retirement. Financial advisors will tell you that, when you're retiring, your last income, let's say you're age 64, and your income was $100,000 a year, you're going to need 70 to 80% of that money when you retire. So you're going to need $70,000 to $80,000 in that situation, and what you might only get through Social Security is $16,000 or $18,000 a year. It's not going to be enough to cover all your expenses and to live the life that you had thought that you'd be able to live. So the third part of the retirement stool, the third leg of the stool, is your own money. And so let's talk about how we can save for ourselves, because that's how life has headed in America. You have to do it on your own. So the next slide talks about saving for the long term. And if you're 25 years of age and you started putting in $1,000 a year, that's $83 a month. Very minimal amount. That's $40 plus per paycheck. If you did this until you're 65, you would have put in $40,000. At a 7% rate of return, just an assumption again, not a guarantee, that $40,000 over time would grow to $218,000. And in my top 15 list, I mentioned the power of compounding. So the money that you put in early is going to grow in a much more significant way than the money you put in at the end before you retire. So the way to remember this is if you put in $1,000 when you're 25 and you had a 7% return, next year you're going to have $1,070. And the next year after that, you're going to multiply that 7% return. If you got that exact return again, multiply that times 1,070 and not 1,000. So this is a great way to save for retirement, is through the retirement accounts that the government has structured for us within your 401k, within your IRA account, and we're going to get through those in a second. But if you would have waited just 10 years and you started putting in money when you're 35, you end up with half of the money, even though you just put in $10,000 less than a 25-year-old. And you can see what happens to the 45-year-old. The good news is if you're already 35 or 45 or 55, your income is much more significant than when you were 25, so you can put in much more. And I'm going to talk to you about how much you can put in this year. Now, the next slide talks to you about how much you would save if you just increased it from $1,000 a year to $5,500 a year at a still 7% rate of return. Now, if you get a 9% rate of return, your numbers are, your end result is going to significantly change. But we're going to use a relatively moderate return here of 7%. The 25-year-old, if they put in $235 a payroll, okay, about $468 a month, they'll end up with $1.2 million in this example. But the person that waits 10 years will end up with half. The beauty of getting to $1 million is once you retire and you want to use some of this money, let's say you take out 7% per year. If you're getting a 7% average return still, you may or may not, depending on your allocation at that time, but if you're still getting a 7% return and you have $1 million, you can pull out $70,000 per year, right? To augment your Social Security income, which is not going to be that great. So you're coupling the Social Security with $70,000 per year, and your $1 million should stay in that same range all the way up until our passing, right? And then you can leave this as a legacy. You can leave it for your spouse, your children, etc. Even give some of it away to your favorite charities. Now, if you only have $230,000 or $238,000, as we have in one of these examples here, if you pull out $50,000 or $70,000 a year because you need it, how long is that money going to last? It's not enough. 7% on $200,000 is only $14,000 per year. It's not going to give you the benefit that you need. This is not a get-rich-quick scheme. I'm telling you, this is 40 years of savings, right? It's being really deliberate. But again, if you are older, you're making a lot more than when you were younger. So how much can you put in to do this instead of $5,500 a year? These days, for last year and this year, you can put in $6,000 into a traditional IRA. If you are 50 or greater, you can put in an additional $1,000 per year. Again, this is because you may not have saved enough, so the government wants to give you a chance to save more money. So you can put up to $7,000 into this account. What is the benefit of a traditional IRA? You may be able to get a tax deduction. That's based on what your income is and whether you have access to a 401k. Something you need to look at. But if you put in $6,000 or $7,000 into this, you'll get that tax deduction. Along the way, you're not going to pay a dime in taxes on capital gains, on dividends, etc. Once you retire, let's say you had that $1.2 million saved up, you pull out $70,000 a year, that will show us $70,000 worth of income, $70,000 worth of income. So then you'll be taxed at that time. So what you could do instead, which is the next slide, is Roth IRA. You can put in the same amount, the limits are the same, but you are not going to get the tax deduction now. You will still get the benefit of not being taxed on any of the dividends or capital gains. But if you save that $1.2 million by the time you're 65, or any amount that you save up, let's say you pull out $70,000, that's going to be tax-free. So for many of us, this is going to be a better choice. There are some limits here, though. If your income is too great, you will not be able to partake of a Roth IRA, but you can do a Roth 401k. Your company should be able to offer that. So that's what we're going to talk about next, are employer plans. So if you own a business, you can start a 401k. It's very easy to do. We help with that. We manage, I think, 220 or 230 of them now. Many of the nonprofits and clinics in the community are customers of ours, and we're happy to help them with that. The costs are pretty low. You can match or not match, but the idea here is to get started sooner rather than later because of the compounding returns. 401ks for your businesses also help to attract the best employees and retain the best employees. Now with the Secures Act, which started in January of 2020 of this year, there's some significant tax credits for businesses, up to $500 per employee, which is, and it'll max it out at $5,000 per year for the cost of a plan. But the plan that we offer does not cost that much, so you might be able to wipe away most of that through a tax credit, something we can talk to you about. The next slide talks about 401k and 403b plans. You might have a 401k through your employer already, or a 403b if you're in a school plan or maybe a hospital plan or something. $19,000 is what you're able to put in 2019, and the $6,000 catch-up is for folks that are over 50. This year in 2020, it's $19,500 and $6,500 catch-up provision, and you can choose the tax-free, the one that is basically like a traditional 401k where you get the tax benefit now. So let's say you put in $19,500 in this year, 2020. The benefit of this is that money is not going to be taxed. So if you made $100,000, you can subtract $19,500 of that. And so $80,500 is going to be where you're going to get taxed. But you'll be taxed when you pull it out. So it's a decision you have to make. On a Roth 401k, you can put this money in, $19,500 this year, and you will have already paid tax on it. But once you get to your end result and you're pulling money out, you will not be taxed on any of that money. So even if your income is $800,000 per year, if you have a company 401k, you can have the Roth 401k, but you cannot have a Roth IRA. So something that we can help you with and answer more questions. Do seek diversification, and know that if you want to roll over your IRA, we can do that for you as well. That's something we can do. And there are other plans. The next slide talks about SEP IRAs. So if you're a business that doesn't have that many employees and you're willing to match for those employees that you do have the same percentage match for yourself, you can open up a SEP IRA, which is another option. You know, these are kinds of questions that you can ask us based on the type of business you have, and we'll give you some of our thoughts on it. You can also definitely consult with your tax advisor, and they'll tell you which one might be better for yourself. But in both cases, you'll be able to save a lot of money for your business if you're a business owner. Okay, we're gonna wrap up just here in just a few minutes and take your questions. So we want to talk to you about the fact that I haven't really mentioned the funds yet. AMANA Income. AMANA Income started in 1986. AMANA Growth Fund started in 1994. The Developing World Fund in 2009. Those are all stock funds. The Participation Fund started in 2015. It's a $125 million fund already. It's the fastest growing from inception, just in 4 or 5 years, has grown to 125 million. It shows the need for diversification, asset allocation, and that's why this one has done really well within the community. So there's risk on each of these. In some cases, there's foreign political and economic instability, adverse movements in exchange rates, currency devaluation, foreign government nationalization, taxation, and confiscation. We just want you to be aware that, of course, in any investment, there's going to be risk. And on the next slide about risk, you can see some specific information here about the funds. And the final page on disclosure of risk is, we'll just say invest with caution and definitely pull our prospectus from our website, amanafunds.com or saturna.com. And there you can find a plethora of information. Also, our annual report is there as well. We do have no load funds, and so that's one of the things that I mentioned early on. You can consult our professional assistants. If you're already working with a financial advisor, you can definitely talk to them about our funds as well. In most cases, they should be able to offer those to you, and that way you can make your entire life be the way that you want to in spirituality. Because if you're already doing all of the other things for your religious benefit, you can also do this with your money. So with that, we will now move into Q&A, and I'll throw it back to Monim in case he has any other thoughts and ideas, and then we'll take questions as well. Thank you very much for your time.
Yeah, thank you, Uwais, for that presentation. I think you did a good summary of all the different types of plans and how we can not only save for the future, but inshallah be able to save some taxes along the way as well. Just one thing that I did want to mention, the samples that were given, that Uwais given about how much money you save and then how much it grows to, we're actually assuming a rate of return of 7%. Now, we don't know what's going to happen in the future, right? It could be 7, it could be higher, it could be lower. But just to give you an idea, the 10-year return on the AMANA Growth Fund for the past 10 years has been about 14.12%. So again, that gives you an idea that if you would have started 10 years ago, you probably would have had more savings than even what the charts are showing, just because, alhamdulillah, the performance that we've had. But it's never, a lot of times people, even our shareholders, will look at, where should they be putting the money? And they say, well, the AMANA Growth Fund is doing the best, let me just put everything over there. But I think diversification, as Uwais mentioned, is a very good idea. And on our website, you can actually find an AMANA selector, and it'll basically just ask you a few questions, and based on the answers to those, based on risk, time horizon, those type of things, will actually give you an allocation between all of our funds, between the AMANA Growth Fund, AMANA Income Fund, the Developing World Fund, and the Sukuk Fund. So please do keep that in mind. Now, there are some questions, Uwais, for you, so I'll start reading them, and maybe you can answer them as
Sure.
I'm doing that. Do UGMA contributions have to come from your parents? Because the limit is doubled for parents. and Rebecca was wondering. And if the parents are no longer married, does the double limit still apply?
Okay, now that's a good tricky question actually. So tricky because I don't have all of the details for you, but a parent would open up the minor account and then the grandparent can help to fund it, and it can be up to that maximum. That's what I know of this. So check further into it, or I can actually do that offline for you as well. But typically,
so let me jump in if you don't mind.
Yeah, please.
So a UGMA is such that it's a gift that you're giving to somebody. In this case, particular case is a child. So really anybody can give the gift. So it could be one of your parents, both, and that's 15,000. Both of your parents, 30,000. Each of your grandparents, another is 30,000. You can, I can give gift. I mean, anybody can give the gift as long as you remember that if you give above what the gift tax amount is, which is I think for this year is roughly around 15,000, then you do owe gift taxes, and the gift taxes are paid by the giver, not the receiver. So just keep them. So anybody can give. So yes, if you're no longer married, still the mother and the father can still put money into the account. You don't even have to do it into the same account because obviously there's going to be one guardian. So the mother can open up one for her child, and the father can open up one for their own children as well.
That's right. So in that case, the beneficiary would be the child, but the parent would be the one that is handling the account.
Correct. So on the same topic, is this assuming UGMA is post-tax contribution?
Yeah, so you've already been taxed on that money. That's what post-tax means. So you've been taxed, it's coming from your checking account. So you're not going to be able to deduct it on your taxes. The benefit is going to come from not being charged on dividends and capital gains along the way. And then eventually when the child, maybe after 18, they may use it when they're 25, it's going to be on their taxes at that time. But there is that tax benefit as well. The other thing that's beautiful about this is that you're not lumping all of your money into one place, as we talked about, in case somebody joined late. If you keep all of your money in one place, you have no idea how much is targeted for your child or yourself for retirement, etc.
So sticking on this UGMA it seems to be very popular. Does opening a UGMA account affect the kids' prospects for scholarships?
It potentially can. The details are, what I would ask you to do is check, because I don't like to give a lot of guidance on this one, because things do change. And if they've changed and my knowledge is not there, I don't want to give information that, would be incorrect. Plus, if the child is 5 years old now, and by the time they turn 18, we don't know what the tax changes are going to be at that time, the scholarship changes are going to be at that time. But usually there's some percentage that would be used. Now, when the child turns 18, all of that money basically is under their social security number. So this is something that you should look into a little bit more deeply, and I will not fully answer it here.
I think Oasis, you're always one step ahead a little bit. So the next question also has to do with something very similar to what you just asked. My parents had an UGMA for me. Now that it has reached maturity, can I transfer it to my IRA? So remember, you have to keep in mind that retirement accounts have specific maximums, right? So what you didn't put in here, and rightfully so, is how much you have in that minor account, which is now your account. So if you had $50,000 in it, you will not be able to put that money into your retirement account, but you could put in $6,000 per year. So you're going to withdraw that money, and then you're going to put the money into your IRA account. You can't do a transfer at that point. Okay, thank you. And then that's very quickly, someone's asking, do you all assist with, must be from Texas, do you all assist with wills as well? Asking because of the mention of trust, and I associate those things together.
Well, Monim, if you want to answer that one.
Sure. We actually, so the process for the wills and trusts is that we are not allowed to help you set it up. You have to do that. If you're doing a will or trust, you have to do that with a lawyer. But after that point, what we can actually do is assist you not only with the investment of that will, but also administrative. You can name us as a trustee on the account, on the will, on the trust, and then we could manage that for you. So those are the things that we can do. The next one is, would you fraction your sukuk for investors with low balances? So that's an interesting question. So what our participation fund does have I think, Awais, you can correct me, it's a $5,000 minimum to open up the account. But once you've done that, then there's no minimum after that point. So you don't fraction a sukuk, but we do offer mutual fund shares that actually invest in a diversified portfolio of sukuk. So hopefully that helps there as well. Okay, so back to the 401ks, and there's a bunch of questions on those ways. Number one, I have 401k from my employer. Can I open up 401k with Saturno?
So if you are a business owner, then you can start up a 401k with us. If you are working for someone, then you would have to go through your employer plan. If you have a 401k with your employer, you can still start up an IRA account with us. That's how you would do that.
Okay, great. At the age of 15 and a half, is there any benefit to convert a 401k account over to a Roth IRA? And what are the general limitations?
Yeah, if you're okay, so 401k, that means that you don't have access to it until 59 and a half. So the question is that, let's say you have that $1 million, okay, as an example. Hopefully, inshallah, you get there. So you have $1 million, and now you say, I did not put into a Roth 401k. I had a traditional 401k, so I'm going to be taxed on all of this. Well, the government definitely wants to, have you pay taxes at that point. So if you're going to be converting it, you're going to convert all $1 million into a Roth, and you're going to pay as if you took out $1 million that year. So instead, what you should do now is, if you're already thinking in that way, if you haven't gotten to that point yet, is start to put money into your Roth 401k through your employer. And what you can do then is you can have two buckets of money, right? You have the bucket of money, which is already in the traditional 401k. And when you withdraw that, is going to be taxed. The other bucket is Roth 401k. When you withdraw that money, there's no tax. So now imagine you're in retirement, you're in your 78th year of your life, and you need to pull out $25,000 that year. You can say, you know what, I didn't have any income this year at all, okay, or I had very little Social Security income. I didn't have much of anything else, so I'm not going to be taxed a lot. Let me pull it out from my traditional 401k. When you're 66 years old, you might say, I had a lot of income come from rental properties this year, whatever thing happened that year. I don't want to be taxed on this money because it's going to put me in a higher tax bracket. So I'm going to pull out money from my Roth 401k. It gives you great flexibility. Most of us have done the traditional 401k. So definitely look at the Roth 401k. You will not get the immediate tax benefit now, but you will get the benefit later on. You'll be very happy if you have two buckets of money.
Okay, thank you. The one other question was, if parents have a UGMA for their children, can they use that money for an emergency?
Okay, now you can use the money because you have access to it, but the rule states that it is the child's money. So you should put that money back in. You should consider it a loan, and you should give that. Now, if you're using it for their own benefit, then of course you can do that. But the rule is that you've given the money. It's a gift to the minor, and so that's why you have some of these tax benefits, the kiddie rule, kiddie tax rule, etc. So definitely pay that money back to the child.
Okay. The other one, this is a little bit detailed, so I'll kind of slow down a little bit so you can answer it. Okay. I have a 401k Roth, and a defined pension from my employer. Then I have a brokerage account, a Roth IRA, standard IRA at Fidelity. Should I open another IRA just to roll over? Is the pension taxes the same rate when I withdraw?
Okay. Wow. Good questions. All right. So this is maybe somebody we should have a conversation with and break it down. But generally speaking, if you do have any kind of retirement account through your employer, if you have an IRA account already set up, if that money is the same, so for example, if it's a Roth 401k and you have a Roth IRA, there's no harm in putting it into the same account because it's the same tax consequences or lack of, right? Now, if you have a Roth 401k and you have a traditional IRA, you would not want to commingle, because as soon as you do that, you're going to change the rules of the game for yourself. And that's going to be detrimental to yourself. If you have a pension, you're either going to get paid over your lifetime or through your lifetime and your spouse's lifetime, or you can take a one-time benefit. And if they give you that one-time benefit, so let's say they tell you can get $2,800 a month until you pass, or we'll give you $642,000. Which one would you like? So you take the $642,000 and you can put it into a rollover IRA, so you will not be taxed, because if you cash that check, you're going to be taxed on the whole amount. We can
Thanks,
talk to you
Luis,
about
for
specific,
that.
yeah.
And also the other thing, sorry, I was going to say, the other thing about pensions is when you're rolling them over, is you're going from somewhere where you don't control the assets, which you don't know if it's halal or not, to somewhere you do control the assets, so you can make it halal also. So that's another benefit to rolling over a pension into an IRA. The another question that was here, and some of it is for me, so I'll let you answer first. He says, "What the market?" So Ishrat actually asks, "With the market being where it is right now, is it advisable to sell current mutual fund holdings in another institution, and in parentheses quite high, pay the taxes, and then buy into the AMIGX, which is also trading very high? Any
Okay.
advantages?" And this is the question: any advantages or disadvantages on the timing of this transfer?
Right. So this question comes up when people want to do a rollover or a transfer. We're going to assume here, because you said taxes, that this is not a qualified account, meaning it's not an IRA, 401k, ESA, health savings account. You can just transfer those over and not pay any tax on it. But yeah, so one of the answers to this is that when you're selling from one place to another, as long as the timing is around the same, there's not going to be much of a disturbance there. So if let's just use the Dow Jones, right? Because that number everyone typically knows. If the Dow Jones is at 26,000, and then you say, I want to make that transfer, as long as there hasn't been some massive volatility where you have a huge drop in a week or so when that transfer is taking place, you should be okay, right? It's not going to come over exactly, but there's not much risk there because it happens pretty quickly.
Thanks, Luis. I think I definitely agree with you in regards to that. So I won't go on from there.
One more thing, Monim. So if you're doing this and you mentioned the tax piece of it, so let's say you have a gain and now you're going to have to pay tax on it. Look for something else that you have a loss in, right? So if you have a loss in some individual stock that you bought, which you should have never bought because somebody told you at a dinner party, and you bought it and now it's crumbled. Everyone's experienced something like that in the past. Well, you can sell that in the same year and offset the gain that you had.
The next question was, how are the funds managed in the AMANA funds in case of short-term stock market volatility, as we have seen in the recent times? Basically, how are my investments protected by the AMANA team? So thank you for the question, Mohsen. Generally, what I would tell you is that when we make investments in the funds, we're doing this on a long-term basis. Okay. What that means is that we're looking at what the prospects of each individual company in our portfolio is over a complete market cycle that includes highs, lows, peaks, troughs, those type of things. So in the past 6 months has been a classic example of that, where market really on February 9th, I think it was, actually hit a high, went all the way down by March 29th, and then actually began to rally here. So in this particular period of time, we really didn't market time, and that's not our expertise. Our expertise is not in knowing when the markets are high and we need to sell, and when markets are low we need to buy. Again, what we're looking for is fundamentally really strong companies in strong industries with strong management that we can hold over a complete cycle. So in this particular period of time, if you look at any of our funds, we might have had some sells here and there, but in general, we were doing it for other reasons rather than saying, oh, the market's too high, we need to sell, or the market's too low, we need to buy. They were more done for fundamental reasons. So now, in this market environment, if we held companies that possibly were going to have a secular shift in the market so that they most likely will not recover based on demographic trends, those type of things, yes, we probably would have ended up selling something. But generally speaking, we like to hold things for the long term. And in the long run, also, there might be some suffering in the short-term performance, but the long-term performance actually does turn out to be better. Again, another question that came up was for you, Ace. Mm-hmm. Are a lump sum pension rollover taxed as a regular IRA, or should it be in its own bucket?
So if you get a lump sum, my experience has been that you can, as long as you can find out about the transfer of it, you can actually transfer it instead of taking the entire amount. That is potentially the case. You have to look at, Monim, do you have more details on that? Because the ones that I've dealt with, you can actually transfer it and not have the tax consequence.
Yeah, I would say if it's a large enough pension, you definitely don't want to take it as cash, because you're going to immediately be hit with a tax bill for that. Whatever the amount is, that becomes your income for that year. Many of the ones that have come up are similar to ways. Have also, you can have the opportunity to put it into a rollover IRA. So once you do that, then you can take out the money, take out your money based on your own projected needs rather than the actual thing. So all will be rolled over, yes.
Like the forms that I've seen from people that we've assisted, they have multiple options. So one of them is like the monthly, and then another one is to roll it over, and another one is to not only take the lump sum, but cash it out. So that last one you don't want to do unless you're willing to pay the tax that year.
So we have like 1 minute. Actually, we're out of time now. So I wanted to kind of conclude. First of all, thank you, always, for coming on and making a very informative presentation. I did want to mention a few things. One of them is that all of the information that's been mentioned here is available on our website, including the returns of our funds, how they've done in the short term, the long term. All those things are there. I do want to recommend, if you don't mind, please do suggest to us future topics that we can talk about. So you can do that. I also want to mention the Halal Money Matters, which is the podcast. I wanted to also mention that a lot of the growth that we've had in the funds has been coming from people like you who act as our ambassadors out there in the community, right? We have a lot of people, including yourselves, that really talk up the AMANA funds of how we've done for you and how we can do other people. Please do keep that up. Let people know about our webinars. Let people know about our podcasts. Let people know about our funds and what they can do to be able to make investments in the long term, in a halal way. And the last thing that I wanted to mention is, please do spread the word to your imams in your community that there is a scholarship fund available for their children to go help them to go to college. So please do spread the word on that. We really appreciate your time spending an hour with us from your busy life, busy day. And inshallah, we look forward to seeing you at our next AMANA webinar. Thank you very much. Wassalamu alaikum wa rahmatullah.
Performance data quoted herein represents past performance and is no guarantee of future results. Investment return and principal value of an investment will fluctuate so that an investor's shares, when redeemed, may be worth more or less than their original cost. Current performance may be significantly higher or lower than data quoted herein. Performance current to the most recent month end can be obtained by visiting amanafunds.com or by calling toll-free 1-800-728-8762. Please consider an investment's objectives, risks, charges, and expenses carefully before investing. To obtain this and other important information, which you should carefully consider before investing, about the AMANA funds in a free prospectus or summary prospectus, please visit amanafunds.com or call 1-800-728-8762.